Well, good morning, everyone. I'm so pleased that you're here with us today for, again, our capital market outlook, as you've all known to grow and love. We're here with, of course, CIO, Magic Man, Mr. He knows everything about the market, looks spiffy today, Joe Taiber. Good morning, Joe. How are you?
Good morning, Michael. Feeling very good, and my clothes are fitting very well. Thank you.
They do. They look wonderful. And I should always throw in like multi-billion dollar man. So today is an extra special day because we are recording this live. So as a new feature, you'll be able to use your Q&A function with Zoom to go ahead and ask questions. So one of the things that we get is some people say, I love what you said, but I wondered about this, or I wasn't quite sure what you meant about that. You got something now. You got a feature that you can go ahead and into the Q&A section, type your questions, and Chelsea's there monitoring the questions as they come in, and she'll let me know in the chat sidebar so that I can get to some, if not all of them. Listen, we've got a ton to cover as always, Joe. I feel like, the world changes so much quarter to quarter. We're going to work to try and give you, because again, it's the most entertaining 30 to 40 minutes in financial services that we know. We're gonna work to get through a lot of information today quickly. So with that, Joe, we got to go ahead and dive in, right? Let's start to look at the data. And again, just as a reference point, we're constantly scouring the world of finance to find great economic data so that we can peer through the noise to review what the data is telling us so that we can make good, fundamental, sound decisions for you, our clients, and their portfolios. So let's take a look at how last year stacked up briefly. See, to me, Joe, what stands out is that last year, the return of the market was between 10 and 20%, right? This is, again, using the S&P 500 numbers. And what I find interesting is that people lose sight of the fact, if you go back almost 100 years to 1926, the amount of times that the market is up 20%, was up 35 times almost in the past 100 years, more than 20%, between 10 to 20%, 21 times. And I also think it's important to note that there were 11 times total, this 5 and the 6, where the market was down 10 or more percent. Here's what I get out of that, and what I get out of this data here. We had an amazing fourth quarter run last year. We had an amazing market run last year in 2020. But this has no bearing on the fact that the stock market tends to be a volatile instrument. It is and always will be. We're off to a pretty good start this year, which we're going to talk a little more about. But market volatility, Joe, is a constant.
Market volatility is a constant. Close your eyes and go back 12 months from now. And that would be probably the most stark reminder for everybody. I mean, we are up, the market, the S&P is up over 75%. From March of 20 through March of 21. And March of 20, everybody knows on this call, I'm sure, felt very different than March of 21. Things feel pretty good, which I'm sure we'll get into right now in terms of the indicators. But my gosh, last year at this time, it took a real gut check to do the thing that was right back then, which fortunately with Henry+Horne, they had the wherewithal to do some right things back in March of 2020, and that was buy when there was blood in the streets. So yeah, volatility is constant, difficult game to play, particularly in the short term, but keeping your eyes on the horizon is how you win the game. And so well done over the past year, Michael.
Yeah, it was great working with you and the group, and that we, March 25th, April 1st, we had meaningful additions to stock market. Looking back, that turned out to be perfect. It also was a great time for us to rotate portfolios, which we did, which was helpful for tax purposes. And for the first time in a long time, what we're seeing now here in this market cycle is we're seeing value, the boring-based value companies, which tend to right now, again, boring-based value, the dividend-paying stocks, you tend to associate with economic reopening companies. We're seeing a reversion there where this long-standing tech domination, and by the way, part of that's captured right here in this chart here. This is the tech domination. We're seeing that value actually ticked up versus growth. We are monitoring that trend to see whether or not that's meaningful and lasting. Because again, we're noting that value rebounded versus growth And it's interesting, even on days like today, and today is the day where the Johnson & Johnson vaccine news wasn't particularly great. And with that, all those economic reopening stocks, your travel and leisure, your entertainment that had done so well the first quarter of the year are having a little bit of trouble today, down 1 or 2%, where those stay-at-home stocks, which had done so well in 2020, are winning the day today. But it's going to be interesting as we start to handicap the ability for these economic reopening stocks to continue to outperform versus growth.
Yeah, value, economic reopening stocks, cyclical stocks. These are things. What is value? You know, is the question a lot of maybe callers have in their mind. Value means it's on sale. You know, that's simple. Value stocks are stocks that are deemed cheap. And this is probably one of the most interesting conversations with the strategists that we work with over the past really few months, because this trend really began rotating in the fourth quarter of last year. This trend from growth to value is really redefining what is value. Value hasn't had a day in the sun since the early 2000s, truly, like an extended day in the sun. When back after the tech bubble burst in the late 90s. And you know what, if you really think about what is value today, the most, I think, interesting conversation is not just a low PE stock, a cheap stock equals value, which used to be the definition for decades. Graham and Dodd, 101. Now there's a bigger emphasis, given the complexion of the economy, there's a much bigger emphasis on how do you value research and development on a balance sheet? How do you value goodwill? How do you value on a balance sheet? How do you value innovation? So coming up with new ways to find undervalued stocks with assets that might not be property, plant, and equipment, but rather a trademark or a technology or an innovation or a therapy. So real interesting conversation, definitely a rotation, something you've been in front of in your portfolios, as I'm sure we'll touch on, but yeah, definitely an inflection point.
No better way to do that than with the travel and leisure trade that was put on in January, which was favorable. Copper and copper miners and things like that helped. Hey, by the way, we got a question. I just want to make sure. Yes, I hear you. I will do a better job in terms of talking about the X's and Y axis on these charts. But let's go ahead and dive into this one here. So on this chart here, I wanted to highlight the tale of the two recoveries that we experienced last year. Again, from March to August. Look at the stock market surged 61% here on this axis. It shows the S&P 500 growth. Then there was a notable pause, and the pause was, in many ways, the stock market a chance to sit back and recalibrate as we dealt with the uncertainty of the upcoming election. Election results were then known, and the market took off yet again. Age-old proverb that the market hates uncertainty. We see the market take off another 14%. But what I wanted to highlight here in the bottom, Joe, and that is you get this technology trade up 81%, big pandemic beneficiary with the stay-at-home. And you can see again, with university and consumer discretionary, these are the two major winning areas as we were going through the pandemic recalibration of what the economy is going to look like. And then as the reopening trade started to happen en masse after the election results came in, you saw energy and financials lead the way. So wow, it was one of the kind of things that we took as a hallmark, where we did own and buy energy for really a short pocket of time in 2020 with a successful short-term trade. It's shocking to see how much energy stocks have rallied, really, off from the bottoms. In financials, rallying, of course, with the steepening of the yield curve, which we've got a lot more data on coming up. But Joe, case in point, this rotation has been absolutely historic, because you don't always see these kinds of returns in these short pockets of time.
Yeah, again, a lot of that is the base effect coming off a depressed level back in March of 2020. But no question, technology were these stay-at-home stocks. So there's your exercise equipment, Netflix, Zoom. Hello, Zoom. So technology type stocks during the real thrust of the pandemic, a pause, no question. The reopening, I'd expand beyond energy and financials. It's really cyclicals across the board. Cyclicals
Right.
meaning energy, financials for sure. You do have a financials trade on with a bank play specifically, I believe, but also industrials, which you participated in, materials, also very kind of center of the fairway, cyclical reopening type trades, as well as the travel and leisure entertainment type thematic, or reopening thematic.
Yeah, and actually, so yeah, to your point, Joe, one of our top 15 holdings has been the regional bank trade, which you put on in February, up double digits since we put it on. So that was great. And then you've got our bonds. So that's the stock market, encapsulated. But how are bonds doing? Lousy. So I'm going to put a little bit of context to it, but from a performance perspective. So I thought this chart was great, Joe. This is one that you shared from Bianco Research. This shows the Treasury performance year to date. This is 2021. Treasury's down 7%. You've got the aggregate bond index down some 3+% year to date, because again, interest rates rose meaningfully. We'll talk more about what they did and what we think they're likely to do. But if you look from a historical context, this is about the second worst bond market, let's say, over the past 50 years. Each one of these gray lines is an annual performance for bonds. Again, if you're getting bond performance up here with a 35%, what you know there is that this happened in a year where interest rates cratered, went down. And when you have bond performance down here, you're likely seeing interest rates recalibrating or rising significantly. But Joe, contextually speaking, second worst bond performance for the first quarter of the year. We're going to talk about in handicap whether or not we think interest rates are going to continue to rise, which would also lend itself to what we're going to do to help ameliorate bond positions, or how to best position our client portfolios for a potential rising rate environment. What do you think of this data?
It's boy, as great as stocks have been, that's how bad bonds have been in 2021. Truly. I mean, this is the 10-year Treasury bond, the long-term Treasury bond, which is another benchmark, just a long, safe bond. Worst quarter in 41 years. And you have to go back to the late 1970s to see a quarterly return like we just experienced January through March. So very difficult. That was down 13%. So bonds, rough road recently, surge in interest rates. We'll put that in perspective, that word surge here, I'm sure, in a few minutes. But yeah, very difficult row. Credit, meaning high yield bonds or corporate bonds, fared a little better than Treasury bonds because you're getting a premium return for the risk you're taking by taking the risk of a single credit or a single, corporate bond. But yeah, difficult quarter for sure.
And here's the thing for clients that I want you to get is that again, the more conservative your portfolio, you'll expect to find more bonds. And so it's particularly alarming when the conservative part of your portfolio, which we hope and expect to be consistent, stable performer, has a negative number assigned to it. We're happy that, on balance, and again, some clients fared far better than others, depending upon your mix between municipals and taxables and corporates, as Joe was alluding to. But we saw far better performance because we had very, 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 very little Treasury allocation across the board. So our clients tended to do particularly well. One of the things that I wanted to highlight here on this chart is that not all is bad with the 10-year Treasury rising. People say, oh my gosh, the 10-year Treasury is rising. This is going to put pressure on the stock market. This is going to put pressure on dividend paying stocks. This is going to be something we have a huge amount of concern about. However, it's interesting to note, Joe, that as the 10-year Treasury rises historically, so does consumer confidence. And we all know the most important link in the chain to our US economy is consumer spending. A more confident consumer spends more. So yeah, we're seeing a rise in 10-year Treasury, but historically that usually goes hand in hand with more spending and more consumer happiness. What do you think about that?
Kind of a chicken and the egg, scenario, because when people start feeling better, they start spending more, more jobs are being created, et cetera, et cetera. Therefore, growth is increasing. Therefore, inflationary or potential inflationary growth pressures would be increasing. Therefore, interest rates go hand in hand upward as well. So what do you do in this situation when you feel like there is an upward bias to interest rates, yet you are a conservative investor? What you probably don't do is buy 30-year Treasury bonds. Right. What you probably do is shorten your maturities, go short duration, and if you feel okay about corporate bond risk, you buy corporate bonds to get that premium interest rate over a treasury bond. So, and again, I believe that's something you have on in your investment programs.
It is.
So something that we see making sense, not just to this point, but for the foreseeable as well.
Yeah, and that's a great point, Joe. So in 2020, we removed our 20-year treasury piece, thank goodness, and we replaced it with short duration, which was just a magnificent trade, which is a big part of the reason why many of our clients outperformed. And so while we're on the consumer, let's talk a little bit about what the state of the consumer is. And there's two different elements that I want to touch on. And that is one, I want to touch on inflation, because again, as the cost of living rises, it's a concern to consumers and it's a concern to consumption, because again, if the cost of living rises a lot, what that essentially means is that you should be consuming less. Less consumption means to less economic activity, and you can understand what starts to fold through the rest of our economic system if that happens. And at the same time is that, what are we seeing with the amount of debt and indebtedness? Yes, there was a surge in Google searching for inflation. We've seen that come down a bit, but the trend here is pretty meaningful. We know that consumers right now are aware of inflation, the cost of living rising. We get that. We haven't yet seen that translate into consumer behavior yet, but what we have seen translate into consumer behavior, Joe, which I am impressed by, startled by in some way, shape, or form, is that the amount of this kind of bad debt, consumer credit card debt, revolving debt, it was on a very steady climb from 2016 all the way through to COVID. And as COVID came, what you've seen is a consistent, steady decline in the amount of this kind of, I'm going to consider it bad debt, high interest debt, revolving debt, consumer credit card debt, which to me says a couple things. One, it improves consumer balance sheets, which is beneficial for future consumer spending. And two, you're seeing consumers do things behaviorally as they were a little bit more concerned, as they were conservative with their finances. And we also know, concurrent to this, we talked about this last quarter, and I don't have more data on it because the data hasn't really changed much, is the amount of cash sitting in bank accounts, 1.7 trillion, the amount of cash in retail money markets at 4 trillion. So you've got cash on balance sheets, not featured in charts. You've got consumer credit card debt, which is vastly improved. So Joe, I like what I'm seeing from consumer behavior and what this portends to future consumption moving forward.
Yeah, I'd say if to use one word, it's probably spring loaded. When you look at the balance sheet, it's hard to. Of course, there's all sorts. There's millions of people out there that wouldn't necessarily agree with this real glass half full type of view, but largely, just generally speaking, absolutely. I mean, personal savings rates surged up to 33%, and so big savings, big cash on balance sheet, labor market improving. Clearly, Google search trends you have up here, searches for travel, vacation, rental cars, restaurants, etc., is really starting to show an energized or an emerging consumer. So definitely one of the more bullish trends that we're seeing right now.
Yeah, there was a lot in that Google trend, Joe, that I had to pick one. I really wanted to put a bunch on there, but I try to give two different sides of the consumer marketplace. So we're going to spend a couple of slides here, Joe, on the bond market, because I do want to come to a consensus, because our clients' common thread is, I can say this, for our younger clients all the way to our oldest clients, and that is they do have a strong desire for us to play defense and to be conservative, when appropriate. And the bond market is one of those great areas within which that we look to seek that kind of stability. And when we look at the bond market, a couple of things I wanted to highlight is here on the left. If you're looking at the 10-year, we have had this peak, but it's interesting to see the difference between where we were in December here in this kind of, let's call it almost like a dark green line, from the 1-month treasury all the way to the 30-year treasury, and how much it has increased. Again, you're looking at a 1.3%, or not a 1.3, you're looking at a 70 basis point increase here. 80 basis point increase here on the 20. And as you start to look through other parts of the yield curve, it's just a remarkable increase in a short pocket of time on the longer part of the yield curve. This move is what created the dislocation and the negative performance in the bond market. This move from where we were in December to March, believe it or not. And if you look at where kind of things could be at its worst in terms of a spread between the 10-year Treasury minus the 2-year Treasury, it could be here. So we have a little bit of room to go before we get to a point in time where we would be seeing some historical stretching on the yield curve steepness. So I wanted to talk about this, Joe, and also at the same time this chart here. The way that I look at it is a couple of different ways. This lime green line is the 2-year Treasury going back from 1995 to today. You can see that the 2-year Treasury, it's somewhere between 14 to 16 basis points today, which is almost virtually zero. And then the 10-year Treasury, which in the mid 90s, was just shy of 8%, and sequentially, decade after decade, sequentially getting lower. And we're seeing these steps downward where you're almost seeing kind of these new highs serving as a cap. So here's the thing, Joe. I acknowledge the fact that we had a difficult quarter, but looking at this step chart, I'm starting to believe that we're setting, and I'm really actively trying to figure out, did we set the high on the 10-year Treasury? How much higher will it get? Because I'm expecting to see this continued step down in what the new high on the 10-year Treasury will be, which would also give us more stability within which where we can invest in bonds with greater certainty.
A couple things. One, the left chart, which has the maturities on the horizontal axis and interest rates on the vertical, that's exhibiting the steepness. You said steepness and the steepening of the yield curve. All that means is longer term rates are rising more than short term rates. Now, short term rates are anchored by the Fed right now, and they drive short rate policy. What the bond market's telling you by steepening like that is it is forecasting increasing growth, higher interest rate, potentially higher inflation over that 3, 5, 7, 10, and beyond year time period. So steepening is a pro-growth indicator or a constructive forward growth view from the bond market. That's one thing. On the absolute level of yields on the right chart, yeah, that's the longer term. I love long-term charts like this. This goes back to 95. If you stretch this back to 1980, it looks even more.
Yeah, you'd be up here somewhere, Joe, I think.
Exactly. So yeah, lower ceilings progressively. It's something that you have to go back to 2011, maybe 2011-ish, to see a high 3% yield.
Yeah.
And beyond that, it's just been progressively lower and lower. The all-time low 10-year bond yield was early August of 2020 at 0.52. Yep. So we've come up from there, not a ton, but a good amount. And it seems like the 10-year is kind of stalled around this 175 rate.
Absolutely.
I don't think our research resources don't think we've hit the ceiling. Right. There's a lot of reasons to think that the bond market sold off a little bit too much in the first quarter, so probably exhausted that upward drive in yields. But it's predicting movements in interest rates is a really difficult. There's hundreds and hundreds of firms that have thousands and thousands of really smart people that try to handicap where interest rates are going, and they all go out of business because it's a very difficult task. But you can make some intelligent at the margin moves, and that's kind of the area that we try to stay within.
Yeah, so I think that the way that I would encapsulate what you said, Joe, is that we are looking for where this upper band eventually settles, so that we do gain the confidence that we can invest more meaningfully in longer dated, conservative based assets once we feel like that top has been put in. But this long-term chart, and you're right, if it went back to the 80s, this stair step's been going on for some 40 years. Yeah. We'll have to wait and see exactly where it goes. And this chart, just again, Joe, just as you said, these are the 10-year Treasury moves going back to 90, where you're seeing like a 2.5%, 1.5% to this is the move higher in the 10-year treasury when it has moved. Here's to your point, the 50 basis point 10-year treasury. Is it going to be a 1.7 move percent off the bottom, which would put us at a 2.2? Is it going to be a 2.5% move higher, which would put us at a 3% 10-year treasury? But what's interesting is that, where we are at a 1.6, let's call it, on the 10-year treasury this morning, because again, we're recording this live, versus the absolute bottom. So we're some 90 basis points higher. So if we're 90 basis points higher and looking at all of these historical data points, it would seem to be that maybe we're a half a point away from that 10-year trend. Now, again, that's a generalization. We don't know for sure, but using historical context, it would be wise to assume that maybe we got another 50 basis points of roll to go.
Yeah, I mean, the step up, probably another 50 basis points. And question two is, what does this mean for stocks? And so far,
we've got that.
I'm sure you do.
Joe, I got a chart for that. I got a chart for that. Oh, can you wait a minute? Can you wait a minute on that?
Yes.
And then I'll let you take. Okay, we'll wait a minute. We'll get right to that. But before we leave interest rates, we'll just put this point right here, and that is that when, again, Joe indicated correctly so, here's this short term, the 1 month, 3 month, 6 month. Again, the part that the Fed controls down here, the short term part of the yield curve, Fed not controlling down here. So when is the Fed going to seek to move higher? If you look right now, the handicap is somewhere, and this is from BCA, the research indicates maybe one rate hike. The expectation is sometime towards the back part of 2022, and then 2023, end of 23, beginning of 24. Now, I've never seen these be incredibly accurate, but it is really good to know what the market's thinking. So is there more that you get from what the Fed's going to do on the short part of the yield curve? Is there more that you interpret from this chart?
Well, this is really important because this is the market butting heads with the Fed. The Fed is saying we're not doing anything until 2024. Nothing. The market, the futures market, does price in expected rate hikes, and it's seeing, as you can see, 3 to 4 rate hikes before 2024 even begins. So 3 or 4 in that neighborhood. So the Fed's saying one thing. The market is saying one thing, which is it's seeing growth exceeding expectations and market forces, i.e. inflationary forces. I'm not talking about 8% inflation. I'm talking about persistent 3.5 to 4, potentially, forcing the Fed's hand to begin to remove accommodation and actually implement some rate hikes. So something we are watching very closely, those incongruent views right now.
Yeah, it is interesting. And because again, in the stock market's reflecting that growth, those increased growth expectations as well, which is part of the reason why it's gone up so much. Mm-hmm. So, okay, Joe, I promised it would be, I had the data on it. So here it is. Bianco's research. Again, you were kind enough to share this one with us. So we haven't seen rising rates, which again, a lot of people fear, but we haven't seen rising rates be a negative necessarily. Now, there was that instance where the Fed really didn't do a great job sharing or publicly discussing what they were going to end up doing. And there was a little bit of a surprise in the early 90s about what the Fed was doing and how the market reacted negatively. But here's what I look at it, like, look at the rate of change in the S&P 500 as rates are rising here on the right. And you've got different markets from 2020 to 2021 or 16, 12. You got a number of different markets where you can go back. And as rates are rising, the market has tended to do fairly well because, again, interest rates are rising because expectations are increasing of economic activity. So, Joe, you wanted to break it down. So here you go.
Well, okay, I'll add a little fine line to that. Yes, interest rates rising generally means growth is increasing, which generally means stocks should be doing pretty well if growth is increasing. So this chart really makes a lot of sense. Within the stock market, where is interesting. You have what we call long duration stocks that are attractive due to their long-term earnings growth power. And then you have shorter duration stocks, more value-oriented stocks. The long duration stocks is another way of saying Google, Facebook,
Right.
Netflix, a longer duration growth technology specifically. And that's where you really saw market internals behave as expected from our perspective, which is those technology stocks starting really middle September last year through the first quarter really lagged meaningfully the value-oriented stocks because the headwind of rising interest rates is more penalizing on the growth stocks than it is in the value stocks.
Right.
So,
I think that's well stated. I think it's really well stated. And I want to. Well, we're gonna keep things moving. I could go add more data to that. But the point is, Joe, I'm in full agreement, and I do want to share a little bit about the total amount of debt and indebtedness that we have right now. Listen, I say this a lot. I say this often in our market outlooks. We could do an hour just on this chart alone.
yeah.
We won't. But I'm just going to try to breeze through because there's two charts. It says a couple of different things to me very similarly. One, if you like long dated charts, Joe, come on. This one goes back to 1900. I'm not going to get you anyone better than this. And this is showing you the amount of total U.S. debt as a percentage of GDP, ramping up to World War II, and then subsequently coming down, moving higher up through the Clinton administration, coming down, and then the financial crisis, a pretty significant ramp up. Here, again, the amount of debt and indebtedness ramping up, which is another way it's reflected here in this kind of, they call it the U.S. debt super cycle, the amount of increase in our U.S. debt and indebtedness. Many people would expect, if we were to have shown someone this chart 2 years ago, 3 years ago, 5 years ago, if I said this is what our debt to GDP would look like, we were going to be issuing that much new debt. The expectation would be our US dollar would drop, inflation would be running high, interest rates would be surging, and none of those things have happened. So I want to talk about that, number one. So that's my first point that I want to make sure we spend some time on. And then two, so let's not lose sight of that. And then two, a lot of people get excited when they think about, wow, I mean, what an amazing accomplishment for the total U.S. indebtedness, the debt to GDP numbers improving substantially. The economy exploded after World War II in a good way, and the debt levels remain relatively stable. So hopefully what we'll see here is that all the trillions of dollars of investment that are happening, hopefully that meaningfully adds to our economic growth. We see our total economy explode higher, and then our debt to GDP numbers can improve because the GDP number hopefully will be significantly larger, but we'll have to see how that handicaps itself. So Joe, getting back to point one and what your take is on these charts, what do you think?
It makes me worry a little bit about my grandkids, I guess, maybe, just because this is an invoice that's going to come due at some point. And really what that means, a couple of things. It means that we're really by and it's no different than an individual levering up on a credit card. What that individual is really doing is spending a lot today, but he or she is really pulling tomorrow's growth forward to today. So what debt super cycles or excessive indebtedness really does is it reduces growth on the forward horizon, okay, longer term horizon. That's one. And the more, I guess, practical takeaways you just highlighted really well, Michael. It's higher interest rate expectations because if there's more of something out there, it should be cheaper. If there's more debt out there, the price of that debt should be cheaper. Therefore, the interest rate moves in the other direction. So interest rates, the U.S. dollar is the other thing, and that's something that the market definitely started to really sink its teeth into, this excessive indebtedness in the U.S. economy last year, and we've had over $5 trillion of fiscal stimulus between 2020 and the most recent package here this year. So that ought to very much be a dollar weakener. We're in the midst in the first quarter. We're looking at the 3-month rally as more of a counter trend rally in the dollar, but longer term view is certainly to the downside, I think, given that backdrop.
And that's a factor and a part of our international thesis as well, which we'll talk about here in a bit. And if you don't know what I mean by that, don't worry. Thank you for the questions, by the way. We'll get to what that is. we got to change gears on the impact of potential tax increases. Now, this is potential, this is an asterisk, this is what the Biden administration has floated out there. And it's important to note that it's far from being final. Biden seems very conciliatory in his tone, meaning that he doesn't seem hard and fast set on the number he proposed. So we'll have to wait and see where we settle in. You're already starting to see CEOs come out and kind of dig in against corporate tax increases. I think I know why. I've got a slide on it. But here's the salient point to me, Joe, is that if you look forward, again, as the stock market does, as you look forward to future earnings, the 2022 consensus earnings per share growth, earnings per share number for the S&P 500 is $201 per share. But with the proposed tax increases, we're going to lose $11.82 of that, which takes our potential 2022 projected earnings per share total number down from 201 to potentially down as low as 190. And what that means is that if you're looking for the consent, we were expecting massive continued corporate growth in 2022, again, as we see it here in 2021, but that we could take that down from a 15.2 to an 8.5. And I would also, I'm going to look for your feedback as I get through this one real quick. And in terms of when do you actually see the market react? We got to look back historically to see when the market will react. So if you look back to when the Trump administration announced tax cuts here, and when the earnings estimates changed, it was when he signed the Tax Cuts and Jobs Act. Because the market knows that when you're making a sausage, there's a lot that goes into it, and we don't exactly know what the final details of the bill are going to look like, and the markets can tend to wait to see it. So we haven't yet seen the market react negatively to the Biden administration's discussion about what tax rates are going to be. So Joe, opening the floor to you, what do you think about Biden administration proposed tax cuts, what that means for the market?
Well, I think there's more time for the sausage to be made. Really, I mean, you're right. It looks like right now what's proposed about a 6 to 8% cut to earnings in that neighborhood, which should translate into nothing more than a routine, regular way 6 to 8% correction in the stock market. So not too substantial right now, only because it's still so far from being finalized. The centrist Democrats in particular, I know there's some real pushback on the corporate tax increase. I highly doubt, or at least the geopolitical research houses that we do subscribe to, it's not likely going to be exactly as proposed. There's going to have to be some compromise, not so much with the other side of the aisle, but internally within the Democratic Party is the hope of the market, certainly. So that's one thing. And earnings, estimates definitely are looking pretty robust for the first quarter. I mean, we're looking at 25% year-over-year earnings growth projected at this point for Q1. So
yeah, isn't it? It's amazing. Well, it's also, I mean, they're easy compares to beat in 2020, but still, their numbers are impressive. And I think part of the rub, Joe, I mentioned we had a chart on it, is that if you look at the total tax, the integrated tax rate, which includes dividends, here's where the U.S. stands currently. There's a lot, this is the data, and there's a lot to be made about if you say, corporations pay no taxes, but when you factor in all the taxes paid, both dividend and on the corporate rates, you add them all together, here's where we stand. And under the Biden's proposed plan, we would go to the worst, literally overnight. And I don't think there's anyone that's in a rush to get back here. But I think this is part of the rub in terms of what the CEOs of these publicly traded companies are thinking and seeing and feeling.
Yeah, one other thing there actually, which I think is really interesting. I don't know where we were prior to the Trump tax cuts, but we had to have been higher, much higher actually, than 62.7 on this chart, only because going to 28% is only going halfway back
right
where it was. So,
yeah.
FYI.
Yeah, it had to be monstrous. So yeah. Agreement. And I would just highlight this. So we don't have to spend time on this one, Joe, but I wanted to make sure we're clear. And that is that sometimes you can make money when there's a change in sentiment. And the change in sentiment is obviously in 2020, the economic world is not over. We've seen the worst of it. And as the sentiment changed, the market was rallying significantly. And you kind of complete the leg of that market move higher. That's one way to make money in the stock market. Then there's a reversion where the market really looks towards earnings to real, okay, great, we got it. Everyone's feeling a little bit better, but now we really need to see it. We got to see the money being made, and we're seeing that a real focus being put on forecasted earnings per share for publicly traded companies. And as we've been alluding to throughout this call, it appears to be very favorable what we're seeing right now. But this is something we've got a very close eye on.
Yeah, no question. I mean, earnings per share, or price to earnings, I should say, is I think what you mean when you say sentiment, how the market is pricing the stocks, PE
Yes.
wise. Yeah. So there's not much room to expand that. The PE multiple at the end of March is at a record high right now.
You're seeing that trail down a little bit from higher record highs. Yes.
Yeah. So this is trailing. So yeah, it's something that there's not a lot of room for multiple expansion, PE multiple expansion, which means the baton needs to be picked up by actual tangible earnings growth. Returns in the stock market come from three places: dividend, earnings growth, and multiple expansion.
Yes.
That's it. There's no other way.
And that rate of increase is slowing down. The rate of improvement is speeding up on earnings. By the way, okay, they got years on the bottom, and these are the year-over-year percentage change. So we're looking at the trend, and it's interesting, kind of the cyclicality of the trend. It's not lost on me. It's not lost on me, the cyclicality of this, and I hopefully will continue to see improvement there throughout 2021 and 2022. International stocks, Joe. We got a few different ways that we're looking at it. We've got 4 different charts. You can pick your favorite. You can introduce a 5th. But I think this pretty much encapsulates it. What I find interesting is that the industrials and financials make up more of these European markets, these international markets, than it does here in the United States. And technology and communication stocks, the hotter parts of the market, certainly where we were, they're more US based companies. It's just interesting to me that there's still kind of this major difference between the two markets, because what we're trying to identify is, do we like the international markets, and if so, why? And with a steepening yield curve, yes, financial banks, things like that, we've got to tilt towards it. They look pretty good. Industrials, again, more of the same. You're looking overseas. If you look at kind of the PE, again, the price to earnings ratio, are things overvalued? The valuation is less expensive there than it is here. Maybe not where we were a couple of years ago, but which is a good thing. This is a favorable thing. We've seen a little bit of improvement in the German 10-year. And if you look at, to me, most importantly, the 2021 forecasted earnings growth, we're excited for the S&P 500 to potentially post a 25% increase. This is pre-tax cuts, tax increases. But internationally, you're expecting even more earnings growth. And we're hoping for a 15 in 2022, but we're likely to have some kind of tax increase. So the US numbers may look worse. And here you are with the international numbers, and you're like, well, geez, it starts to look a heck of a lot more favorable, whether you're looking at the type of industries that exist overseas, which are the kind of things that we may want to invest in this cycle, economic reopening. If you're looking at multiples and valuations and future earnings growth, I didn't even have the dollar on here, but it looks like there's some major tailwinds favoring international, which we're leaning a little more heavily towards right now.
Yeah, and in the process, as you know, with your investment committee, in the process of leaning even more to over the past couple of days, anecdotally. So looking at the IFA, which is really Europe and Japan, there's more cyclicality. A weaker dollar environment should favor it pretty well. It is cheaper, expected earnings growth as well, definitely bolstering the case for developed market international. And you're really clear about that. Just what I mean by that is mostly primarily Europe and Japan. Emerging markets is a bit of a different flavor, and that's, as you know, Michael, something that we're starting to rotate away from right now, given our view on China.
I was going to say China. Yeah, I know.
Yeah, you got it. So our view on China is a little less constructive right now, just because they're beginning to remove accommodation monetary and increasing some regulation. So we're in the process right now of pivoting away from some emerging market complexes, China specifically, and more towards developed market international that gives you these flavors.
Right, and I think that's going to be the right place for these data points plus others. So goodness, I got a couple more charts. I'll fly through this one pretty quick. But here's what's interesting to note is that there are parts of the market where we've left kind of the realm of natural. The market returned a heck of a lot more than real GDP growth. We're aware of that, which was largely driven by the actions that the government has taken to help support the economy. We get all those things. And again, that we've got these charts, and I'm happy to send this out. Plus, there are exhibits at the end of this because there's things that I already put that we weren't going to be able to have time to go through that you may want to go ahead and review. I've got some great charts on inflation. This I think is important to note. Where we are in this economic cycle, we're kind of in this Goldilocks, strong growth and easy Fed market here, which is helpful. And if you're trying to figure out how the second year of stock market bull runs tend to go, you can go back, again to 1957 all the way to 2020. Here are the major market moves off of lows. And the average second year return is 12.7. And it's interesting because if you look at the first quarter results and kind of where we are right now through April, we appear to be headed towards this 12.7 number. And it's not to say that there isn't a potential for drawdown at some point this year. We're aware of it. Could be as much as 17 drawdown, meaning a short-term move down. We're aware of it, but we might see a 10% move down. But the expectation with all these data points considering, if you look at historical data, a 12% year potentially, which would be great.
Yeah, and I think your last comment there is really important. The first year off a low is always, all gas, no brakes. It's like that very often. Second year is a little trickier. Usually has a good follow-on year, but not without volatility. I would highly expect, particularly given the valuation of the market today, I think it's vulnerable to any bad news, really. That could be geopolitical, that could be some Fed talking points. It could be a lot of different things, but it is vulnerable to one of those high single-digit, low double-digit, very normal and healthy, frankly, type corrections. So that's
it's interesting. And it's funny because all the data points that we've talked about kind of, I think, boil down to that chart. So what I would like to, that last slide, what I'd like to do is there's two slides that I'm going to conclude with, and that is things that we need to be looking out for the bear market, things that we're going to be looking out for the bull market, because we're trying to forecast essentially the direction of where the market's going. And there's a lot of things that we don't know, but we're going to give you the things that we're looking at to give you an indication about how we are seeking to migrate and make changes to the portfolios, whether it be more conservative and or more aggressive foot on the gas. So here is the bear case. The bear case is that, and this is number one, by the way, this was before the Johnson & Johnson situation in the market down this morning. Will the vaccines continue to be effective? We need to see that continue to go forward in order to get a solid economic reopening. Will the stimulus continue to flow? Will there be a meaningful change there? Will the Biden administration not be able to get the infrastructure spend? We don't know. Will the tax hike be more muted? Will it come in heavier? Is the Fed going to remain on the sideline, or are they going to make a change to their relative dovishness or supportiveness of the market? Will interest rates remain low? And will the debt load all of a sudden become unsustainable? So if we lose one of these six really key areas, then you should know that one of these six things will likely start to trigger in us some additional conservative stances. Any one of these things jump out at you, Joe? I mean, I know they all do, but.
Well, as Mark Twain once said, it's not what we know, it's what we think we know that just ain't so. Yeah. Right. That's the danger here. So all of these things: vaccine, stimulus, tax hikes, the Fed, interest rates, and debt. No, these are all, I'd say, consensus views. We don't really push back or have a counter consensus view on any of these. The vaccines, we feel, are going to continue to find their way into people's arms, which are going to normalize economic behavior. Stimulus is pretty much locked in for 21. 22 is likely to be more of a fiscal drag. We know that. So the likelihood of a fiscal drag in 22, we're expecting. How big of a tax hike is something that we already touched on. The Fed, until it starts to change its narrative, which ultimately it will, and we of course are monitoring very closely. We're consensus there. Interest rates we're watching, and we do feel like we've hit a nice pause here. Next leg is probably higher, but still we're not at a point where stock markets we expect to be pressured because of rising rates, as one of your charts touched on really nicely. And then the debt load, that number 6, honestly, that is very much a longer term or longer duration concern for our kids or our grandkids, at least at this point. So not an immediate concern in terms of risk posture in a portfolio.
Right. Well, yeah. So these are the elements. These are the key elements that would make us bearish should we start to lose some of that momentum. And then, of course, the bull case. There are a number. Again, we're seeing unprecedented support, not just here with the Fed, but the PBOC, the People's Bank of China, the European Central Bank, the Bank of Japan. We're seeing this kind of worldwide, unified, global liquidity. That continues to be a bullish sign for the stock market, and the economy is continuing to ramp. We're seeing pent-up demand. We haven't seen any change there. Economic activity is gaining steam. We're seeing that across many different sectors of the economy. We're seeing China, which was a little bit slower in that first quarter of the year. We're seeing them really start to accelerate, which is something that, hopefully we'll continue to see the support there on various aspects of the Chinese economy. And, we know that, yes, there has been this short-term move higher, Joe, with respect to the amount of money that's gone into the stock market lately, but we haven't seen the amount of money that's being plowed into the stock market. We haven't seen that hit these incredibly record, huge high numbers that make me believe that the rally is overdone because of the market moving, because of too much money finding its way into stocks. Mm-hmm. So I'm looking at all those 5 key points and saying, right now, with the consensus being on the bear side and the bull side, I look at the bull cases and it seems more like business as usual.
Yeah, I'd agree. I mean, which is why you're close to fully invested, but acknowledging the what I think is a pretty high likelihood for a hiccup. Again, a routine, regular way volatility hiccup, which we're in the process, as you know, of preparing for at the margin right now. So very bullish looking forward. Expect volatility per usual. For sure, but yeah, I think the glass is definitely half full just in terms of what kind of posture portfolios risk-wise should be taken right
now. Joe, there's good news. You know what the other good news is, Joe, is that if you did 53 minutes of this video, if you hung in for, you have no need to watch CNBC, Fox Business, Bloomberg for like a month or 2. You could take time off. You have just squeezed in an economics master's class in the stock market in 53 minutes. We covered everything. There's no way it could have been more fun or enjoyable or informative. Joe, you hit home runs consistently, not even doubles. You hit home runs consistently again today. I appreciate it. Thank you for matching tones. It's kind of this light. I got the light purple. You got the light blue. It's very soothing. So thank you for that. I appreciate it.
Very, very, very welcome, Michael, and always a pleasure. Honestly, great working with you guys, your clients as well. Hopefully, have a good grasp on what you're doing so that they can understand how things are behaving, and very much appreciate the time.
Yes, and after going through this, if you have questions, if you find yourself with questions, issues, thoughts, you need to know more. That's what email is for. That's what phones are for. Call us, email us, let us know. We'll provide clarity. We'll give you the slides if you want them. There again, I'm not going to get through the appendix because there's a lot of things there too. Joe, I'll trim a few slides next time. I keep saying that every time, but I'll trim a few more slides and then we'll squeeze it. We'll get another 10 minutes at less. I'm telling you, next time it's going to happen.
I thought this was pretty tight.
Thank you guys. Take care. Have a great quarter. Let us know how we can help. Bye-bye.